Hello, everyone. Let me know once you can hear this voice. If you can hear my voice, please write on the comments so we can start. All right, amazing, guys. Thank you so much. I first of all, I apologize for the late start. We have some minor technical difficulties, but everything is all good now. So I am Ram Martinez. I am currently the GFB chair for 1819. I'm also going to be the GFB chair for 1920 as well. Maybe on the next few sessions, you will hear me this kind of introduction. So just let you know, I'm kind of returning. So in terms of the summary for this session, so we're going to tackle about the standards and the indices of how we are doing with finance. I'm going to focus more on sustainability standard itself, then ratio calculations, then why product sustainability, how to improve, and questions and answers. All right. So first is in terms of the standards and indices. So this is just a quick overview. Why do we have finance standards in the first place? First is to ensure we as AIESEC are 100% legal and sustainable in our operations at all levels. So we wanted to be able to align quality among different realities, easier education, ensure legality and protect organization, consolidate data, set expectations, ensure minimum, and ensure financial and legal sustainability. As you can see, there are six standards as uh, as they are arranged in very easy labels as well. Like I usually can memorize that by just saying LARBAS, like legality, accounting, reporting, budgeting, auditing, sustainability is just a lot easier. All right. So why finance standards are important? So the way a usual cycle of an entity would go, like from the first year of how they should be able to prioritize until the more years to come, they need to be able to first focus on their legality as because if you can't do much and because if you cannot focus on legality, then that means there are a lot of things that you cannot do a lot. Like for example, if you don't have legal registration, if you don't have bank account, if you don't have the proper visas and contracts, then it would be very hard for us to do our operations. Then, as years go by, only if budgeting, accounting, reporting is well done will we manage our financial info properly and take better decisions. So that means every year we always need to think about budgeting, accounting, and reporting, as will be the main financial management process. Auditing comes in different periods, usually annually or semi-annually. So they are dashed lines representing the annual audits. That's why we have external audits, as you know. Meanwhile, sustainability represents the green line, depending on how high or how low your improvement with sustainability. This is not necessarily just a 1 year period, but it is a continuous maintenance. So yes, you can say that your job transcends your 1 year term, but that doesn't mean that just because your sustainability you still need to wait for more months to come. That doesn't mean that you don't have to do anything now, because that would be like, oh, you're just depending your resource on the next month, but the resource of years to come or months to come would always be a reflection of what you are currently and and historically doing. All right. So you may know or not the finance health indices. So the thing here, if you're going to look very quickly, so we have six standards: legality, accounting, reporting, budgeting, auditing, sustainability. So we divided those into different indices. So first is financial process index. So this is the index that evaluates compliance of financial processes. This is measured by calculating legality, accounting, reporting, budgeting, auditing, meaning the first five standards itself. Then financial sustainability index is the solely for sustainability standard because this evaluates growth and structure of sustainability of the entity. The reason why this is only just one solo index is because Sustainability Standard has five categories, which are entity sustainability, product sustainability, HR sustainability, other financial indicators, and risk management sustainability. If you're going to look at the side, there is like a summary version of why this makes sense as an index. Because FPI focuses more on systems administration and work routine. So this is more on how is your routine, how what is the foundation that you have. Meanwhile, FSI focuses more on financial performance, pipeline, and stability. So this is more on the results of how you are doing with your work. So if you're going to combine those two, there would be overall financial finance standards percentage. So this is how the weights are currently allocated, as you can see, based on the color, based on the percentage. If you're going, the overall FS percentage is literally just average of the two, like they're just the dividing FPI and FSI into two, so that you can get 100% on each. Yeah. So why these weights? First, it's because of roadmap priorities, current 1819 roadmap priorities, wherein those who wherein legality, entity sustainability, and product sustainability will get higher percentage. Yeah, then maintaining the minimum is wherein we wanted to put legality as well has a bigger percentage within FPI itself because one, you cannot really do anything if you're not legal. Second, there are a lot of items under legality comparing to everyone else. So that's why even though the other standards have lesser percentage, but that's also because they just have fewer items to be checked. While legality, there's is a longer checklist, so it kind of balances out. Then focus on financial management and financial results, that which is the reason why the sustainability entity product and budgeting and also other financial indicators have a bigger percentage than those of accounting, reporting, auditing, and risk and HR. All right, so this is like the logic behind the index. So FPI is the foundation aspects. That's why they are on the x-axis. They're more on the floor. Then growth aspect is FSI, so meaning going up. So that means the more you the more you go to the right for foundation aspect, that means the stronger your foundation is. The more you grow to the top, that means the more you are growing with your performance. So the more ideal place on where you would land is going to the top right, ideally. So if you're going to look at these entities, just a quick example: entity 1, 2, and 3. Entity 3 is more the one that is more financially sustainable in both FSI and FPI. Now, as you may know, if you remember, there is the finance health dashboards. These are just the graphs related to finance health dashboard. I am not going to talk about this in this session. I will talk more about this in a different session. All right. All right. Next is sustainability standard. Sorry about that. All right. So as you remember, where is sustainability? It is FSI. So FSI is just mainly on the growth aspect. So we're only going to talk about this one. Sustainability, as you remember, there are five subcategories, which are HR sustainability, risk management sustainability, entity sustainability, product sustainability, and other financial sustainability indicators. So very quickly, just HR sustainability the logic behind it is first to ensure pipeline and team standards. Second is education cycles for LCVPs. Below are the items related to these two, which are mainly related to about sharing of roles, about fulfilling team standards, about how we're doing with education. You can read the items in here. Next would be risk management sustainability. So risk management sustainability is mainly related to risk assessment and management. So there is a framework slash tool where where risks such as integrity and security, finance, legal reputation, future operations are identified. So there is the ideally if is that you need to have a matrix, action steps, and log on risks and how you can mitigate for future reference. Now, in this one, I'm not also going to talk about this one because this deserves to have a separate session, as you can see in the agenda. All right. So entity sustainability. So this is how the logic of entity sustainability, wherein else for LC sustainability, this highlights that LCs needs to focus more on exchange. So that's why if we're going to look on how we're doing with the comparison, the the exchange cost, the exchange revenues are the ones that we are highlighting more in terms of the inflow. So level zero is if exchange cost is bigger than exchange revenue. Level one is if exchange revenue is bigger than exchange cost. Then level two is if exchange revenues is bigger than total cost. So total direct and indirect cost. MC sustainability level two uh, is where this is focusing more on how MC operates. Now, the difference here with LC is that MC receives LC fees or entity affiliation fees or national affiliation fees. It depends on how you're calling it, but basically the fees that you charge the LCs depending on your distribution model. So levels you can if you are level zero, that means your MC is at loss. If you're level one, that means total revenues is bigger than total cost, and then level two is total exchange revenues and LC fees is bigger than 70% of the total cost. Now, for level one is basically just asking if your profit if your MC is at profit. But in level two, it's slightly different because it's checking on if your MC is profitable if they are focusing more on their core performance, which is more on exchange revenues and LC fees. So that is the focus more with level two. Now, entity sustainability is where if you're going to combine LC and MC. Now, the thing here with entity sustainability is that it's asking more for the combination of the two. So that means the entity affiliation or LC fees, which is the cost of an LC and a revenue of the MC would not be counted as a combination because they basically cancels out because that an outflow in LC is inflow in MC when it comes to LC fees, right? So for entity sustainability level two, level zero is when an entity as a whole is at loss, whether or not the entity comes from the LCs mainly or from MC mainly or both. Level one is when consolidation is a surplus. Then level two is when MC sustainability level two and LC sustainability level two are reached, meaning LCs should be able to generate enough exchange revenues to cover their total cost, and MC should be able to generate more on their core business to cover at least 70% of their cost. All right. Product sustainability is simple, to be honest. In terms of the formula, but not simple in terms of working for it. So product sustainability is where uh, level zero is if your product is at loss. Level one is direct revenues bigger than direct costs, and then level two is if direct direct revenues is bigger than direct costs plus indirect exchange costs. For the formula of indirect exchange costs, I will tackle more of them later on. But basically, for product sustainability, it applies to all of every product. It you just have is going to be the same formula. All right. Other financial indicators is where there are six main indicators here. So first is months of financial reserves. The months of financial reserves is wherein you would evaluate the financial capacity of the entity, because financial reserves is basically your financial cushion on how safe you are, or if you have a safety net in terms of if you are keep on generating losses. So the thing with MOFR is that if MOFR is less than or equal to zero, meaning at negative, you are at critical financial situation. If MOFR is between 0 and 3, then dangerous situation. If it's 3 to 6, high risk. If it's just around 6 of months of financial reserves, that is the optimal situation. Then 6, if MOFR is bigger than 6, then that means you have some unnecessary reserves that it doesn't have that much purpose. Now, the formula here is that we're using equity divided by average cost of 12 previous months. The reason why we're using equity is that it is you are already taking out the account of debts or payables that the entity or LCRMC needs to pay. So this makes it that equity is the account where it is more holistic number, because you are not in taking into consideration the liabilities anymore, so that it wouldn't seem like, oh, okay, you may have MOFR but you have payables to pay. So it's more on a clearer ground. Yeah. Then we are using average cost of 12 previous months because if we go because it would buffer out different extremities in different months. As you can see, there are peaks, there are conferences are on different dates as well. So it's just by averaging it, we are buffering them out. All right. So, but yeah, basically, most of financial reserves, the idea here is to be able to, for us to measure how safe we are with our finances if we are keep on generating losses. All right. Next is all conferences are sustainable. Basically, don't generate a loss. Conference revenues don't depend on sales, and have conference guidelines and reports for knowledge management and transition. So ideally, your finances should come mainly from the not from sales or from delegates, ideally, and also conferences should not be at loss. Yeah, and ideally conferences should have a good education transition so that your successors will not repeat the same activities that could have made problems with their past conferences. All right. Next is liquidity. Liquidity is where every quarter check your liquidity. So liquidity, the idea of liquidity is that it's asking how li- it's asking how liquid or how how much cash flow you will still be able to have if you have some payables that you need to pay. So it's asking more on how big your cash are or assets. So these are the formulas. As you can see, cash divided by short-term liabilities should be equal or bigger to 1. Or and then current assets divided by current liabilities should be between 1.5 and 3. Meanwhile, that ratio is like the opposite of liquidity, wherein it measures more on how most of the organization's assets is financed through equity rather than debt. So it's asking more on total liabilities divided by total assets. Ideally, should be less than zero point 0.5. This means ideally your debts towards to anyone that you have should be less than 50% of your assets. Yeah. All right. Core performance is basically looking more on your core business within your entity. So as core performance for LC is mainly from direct exchange revenue. Core performance for MC is direct revenue and entity affiliation fees revenue. Meanwhile, core performance for entity is direct revenue itself, but MC and LC is added. Now, ideally, it should be equal or less, equal or greater than 70%. Why? Because I as a core performance, we should be able to generate as much of our revenues from the main operations of the business. The reason why MC has the entity affiliation fees here is because the way that MC operates is that they get the money from through the distribution model, and they're usually not the one who's directly selling to different customers. So that's why it is in here. But for entity, we don't put the entity affiliation fees, mainly because it already cancels out when you add in the LCs MCs to get LCs and MC revenue together. And because entity affiliation fee is a cost of LC, it is a revenue of MC, so it cancels out. Then the other one is direct cost divided by total cost. Currently, this is not part of the calculation of finance standards, the direct cost divided by total cost, because there's no set ideal ratio for this as of now. But this is where, to in order to scale up our operations, we need to invest our financial ratios into more into direct costs. Currently, this is not officially measured towards finance standards percentage, but this is just something that easy to know because it is the one that is included in the finance standards. All right, ratio calculations. So for ratio calculations, I'll only focus on these two, entity and product sustainability. For the other sustainability, this will be focused more on a different session. Sorry, other financial. Sorry, let me repeat. Entity sustainability and product sustainability will be focused on this session, while sustainability of other financial indicators will be focused on a different way. All right. What is the scope of calculation, by the way? So, the scope of calculation is that for balance sheet related accounts, so meaning like liquidity, debt ratio, months of financial reserves, we check more into of current month's data. Meanwhile, profit loss accounts are those ratios that is related to financial performance, such as entity sustainability, product sustainability, core performance. This uses more a total of past 12 months data. Now, what do I mean by past 12 months data? If the report states April 2019, then that means the revenues and costs data used comes from May 2018 to April 2019. Then every month it would always change, so that means it will always be a month forward. But the idea here, why 12 months data, is to avoid extremes and focus more on long run and holistic analysis. What do you mean by extremes? Peaks differences. As you know, summer peak and winter peak happens on months during summer and winter. There are also different months that we consider as off peak when it comes to revenues and cost. The fluctuating cash flow patterns as related to this, because there are months that are very high, of course, of cost. There are months that are very high of revenue. There are months that are very small changes with finances. And also in every month across the 12 months, there are different priorities and events, such as conferences that usually happens in like 2 or 3 or 4 times in a year. In terms of special events like youth speak, it happens on a different time. Such in terms of like legal obligations, it happens on different time. So there are different priorities and events in different months, and that's why we're using 12 months data so that we can buffer out those differences. All right. Next is entity sustainability. So for entity sustainability, on how this is currently calculated, is that for LC and MC sustainability, if they reach level 2, then it's 100%. Level 1, 50%. Level 0, 0%. For entity sustainability, if they reached level 2, then it is 100%. But this can only be reached if LC and MC is reaches level 2 as well. Level 1 is a 50%, level 0 is 0%. So as you can see, this is just an example. If they have LC level 2, MC level 0, entity level 1, then that means 100% plus 0% plus 50% divided by 3. Then the your overall entity sustainability will be 50%. And from here, you can see which part are you having more problems in. All right. Next is product sustainability. So for product sustainability, for each product, if they reach level 2, 100%. Level 1 is 50% plus. the level 1 profit divided by indirect cost times 50%. Then level 0 is if level 0. If you're not running the product, then it is not counted. So how do we calculate this? Level 1 profit calculation is where direct revenue minus direct cost. As you know, because level 1 is only counts direct revenue and direct cost. This is assuming that direct revenue is higher than direct cost, right? Cool. So by taking level 1 profit of the product, then dividing it to indirect cost, this calculates the percentage of how much of the direct earnings from the product itself can cover the indirect cost of the product. So it is in assumption that if the direct revenue is higher than direct cost but not high enough to be able to cover still the indirect costs, then we get that percentage, then multiply it by 50%. So the that sum plus the 50% by default would be the level 1 percentage that you would have. In terms of calculating overall product sustainability, as you know, there is 6 that we could count. So we just need to average all products run. But if you are not running certain products, then it would be a different number. So this is an example. So as you can see, IGV, OGV, IGT, direct revenue, direct cost, then sum, then you minus again the indirect cost, then you have profit. Then in this case, IGV is level 0, OGV is level 2, IGT is level 1. So this is an example of how IGT level 1 is being calculated. As I mentioned before, level 1 profit divided by indirect costs. So you can see 5,000, 4,000, and 1,250 for indirect cost. So 5,000 minus 4,000 is equals to 1,000. 1,000 divided by 1,250 equals to 80. Now, product sustainability calculation. So 0% for IGV because they are level 0. OGV is level 2 because they're 100%. Then IGT will have 50% plus 80% divided by 2 is equals to 40. So 50 plus 40 equals 90%. Then overall product sustainability, because there's only 3 products here. So you add all of those results divided by 3, then you get 63.33. All right. Now, in terms of indirect exchange cost, so this is the calculation, right? As you remember, level 2 has indirect exchange cost. So how is this calculated? Indirect exchange cost would be core performance of entity times total indirect cost times the average of direct exchange revenue by product, direct exchange cost by product, then percentage approvals by product. So how is this calculated? So first in core performance, this is total exchange revenue divided by total revenue. So that is simple enough, right? So you just add all exchange divided by all sources of revenue. Then total indirect costs. So you add all of the indirect costs, meaning non-exchange cost. You add all of those. Then you have IGV. As for this case, I only use IGV as an example. So percentage of exchange revenue, that means direct exchange revenue of IGV divided by direct exchange of all products. Then for direct cost would be percentage of direct cost would be direct exchange cost of IGV divided by direct exchange cost of all of the products run. Then percentage of exchange or approvals by product would be IGV approvals divided by all of the approvals. Now, just to go back, what is the logic behind this? So the thing here is that in terms of indirect cost, the in terms of indirect cost, there are multiple realities, extremes, and differences across the entity. So we need to be able to have a good formula that can be applied to all of the entities in a much more holistic way. So that's why we're considering direct exchange revenue, direct exchange cost, approvals, because there are those differences that comes in here where some entity have more revenues, some entity have more costs. There are times that entities has smaller approvals but bigger costs. So those are those differences, and then by being able to average them out and considering them in this kind of formula, then we are removing those potential extremes. Then We consider core performance of entity because the core performance would act as identifier on how much is your of your total indirect cost should be allocated towards exchange and should be allocated towards non-exchange. So because as you know, core performance is direct exchange revenue divided total cost. That means the total indirect cost that will not be counted here is not that will not be counted in terms of the results would be should be absorbed by non-exchange sources. Yeah. All right. So why product sustainability? So if your product is unsustainable, that means that every amount being invested into the product goes to a loss. If your product is growing disruptively but remains unsustainable, that means this growth would lead to losing money disruptively. So that means you may be growing, but you keep on being unsustainable, then you're making the losses a lot bigger. If your product will stay unsustainable and keep growing, this could lead to bankruptcy. So the general idea of sustainability is like value of organization, value of members, value of market. So sustainable product is within those three aspects. So value of organization is where costs incurred for operating the products and maintaining the business is well funded by core revenue. Value of members is where manpower for function and delivering the services is sufficient and satisfactory. Value for market is that the price of the product is worth it to the customers and willing to spend. But what if something bad happens? So, for example, direct cost is bigger than price. That means there's negative margin. If main activity or main activities that we do or main functions that we do is not equal to the main income, for example, division of people is not versus division of margins, that means there's low efficiency because on how we prioritize where do we allocate our people. There are times that there are entities that they put more people on events rather than exchange. That means there is no alignment in terms of how the operations of the people would align to how we should be able to generate more income. Then indirect costs can be bigger than the margin, so that means there's loss after indirect cost. So this is just an examples of what could happen. Like what if housing cost is higher than what you budgeted? What if pricing isn't high enough? Another example is slow conversion equals slow efficiency of members because they can they because you don't prioritize enough in terms of how you would allocate the members or in terms of training members. Then there's way too many people allocated to back office than those in operations. Another example is that poor understanding of products. That means there's poor sales and delivery because because if they don't understand it, they cannot communicate it. Then fixed costs cannot be covered by the profit margin, which would also lead that the business would also have a problem internally. So these is why we tackle product sustainability, because there are a lot of connections of how the products work to our organization itself, how the products connects to members, how the products connects to the pricing, how the products connects to expenses. And this is something that we need to focus on. So the scope of calculation is that, sorry, the scope of sustainability is that sustainability is achieved is a when the business is able to deliver services to the customers at a price that covers their expenses and generates a profit. All right. So how to improve? So these are just few tips that we've been promoting all around is that first, legal operations, you need to ensure that product is legally compliant. So what does this mean? You should ideally you should need to have national policies such as regulations. You need to ensure visas and work permits. You cannot have them join illegally. You need to have your contracts and you need to be able to ensure your compliance with insurance. Next is budgeting. You need to check in terms of how you're doing with the budget. So you need to be able to connect it with the customer flow. You need to be able to back that up with data, meaning avoid emotions or avoid feelings of, oh, this may happen, but but based on history is different. Indirect cost, you need to take that into account. And then target profit is that you need to be able to have a target profit during your term in the terms of the products. Pricing is where we sell our product for what it's worth. So our pricing should be able to fully cover both direct and indirect costs. If we need to think about repricing, do it. GFB has a pricing tool which we will soon promote. Then there's also GFB pricing evaluation tool which we will soon re-promote. Then next is in terms of fee structure. You need to think about how the structure of the of how you charge your partners, your customers, and how the delivery of the service. So charging can be one-time payment. It can be monthly servicing fees, a combination of one-time payment and monthly servicing fees, or multiple fixed installments. The fee structure usually applies more towards GT. Yeah, so cost cutting is where small spending comes a long way. So strategic alliances and income sponsorship. So this is where if you can cut your costs but be able to invest on alliances or sponsorships that are not necessarily monetary, but they can replace some expenses and items that you need to spend on, then that would be a good way to be able to cut your costs and save more money. Then constant tracking is, if it is not measured, then that means it's not managed. And this is why data is very important, where you need to have constant reporting and meetings, so that you need to have regular discussions with your VPF, discuss current status, and then you can only improve with your product for profitability if you're aware of the state. Then be careful with discounts, by the way. Be very careful with discounts, because this could be a blessing or a curse. So blessing or a curse meaning deduction from profit, where lowering the price of the product for a short period may be able to attract more people, can be effective, but make sure it's taken from the profit of the product, and not and the profit and the product can still cover direct and indirect costs. That means if you are going to put discounts, make sure that you are not sacrificing your revenues too much to the point that you're not be able to cover your own cost itself. So that's why it can be a blessing or a curse. So sticking to business model, so how we are charging with partners. So we need to be able to identify on how to charge enough. So there are products that somehow charge EPs, like usually Global Volunteer. There some most of the time or sometimes partners are not charged enough to cover the cost of the product, which eventually charged by AIESEC or EP. Then we need to find partners that can finance the project. Tracking your ROI. So what does this mean? Return of investments boosts operations, making our entities able to deliver more experience. So ROI is if we keep investing on different cost items, but have no clue on how much we are actually getting. So we should probably start reconsidering this. We should probably start measuring them, or what do we expect from the investments. In terms of investments as well, there are times it would be good if you can replicate investments. That means if an investment is good, then you replicate it. Then you just continue doing it again on the different periods. If an investment is not good, probably don't do it again. So you probably better to discontinue them and away from future plans, because they are not giving you more money. Now, again, in terms of charging of partners, ideally, IGV opportunities, there's always a regular discussion on how we should be able to charge the partners, as you know they are NGOs. So this is one of the models with IGV, is that the triangle model. This is one of the models so far, which is multiple stakeholders are sustainable for sustainable impact. That means AIESEC will be responsible to provide the EPs. Companies will be responsible to funding the initiative or the project or opportunity. Then NGO will run, manage, direct the people to to whatever the goal of the opportunity of the project is. Then ensuring transparent payment. So being transparent with charging our IGVEPs. That means your costs should be in detail. The platform guidelines should have those details. And stakeholder touchpoints is that ensuring cost structure is attached in all touchpoints with OP takers, companies, EPs during the whole process. And yeah, so that is everything for this sustainability overview. So if you want to contact me, please save this contact. My name is Ram Martinez. This is my email. This is my WhatsApp number. I will give you 4 minutes to ask me some questions. In Please write down your questions in the comment box below. In case you don't have any comments, please write down wave in the comments box so that we can close this call. Will I be sharing the presentation of this webinar? By the end of the entire global education webinar, we are gonna announce sharing the links and the PowerPoint, so you can check them again. All right, so I guess that is it. So again, thank you so much for everyone to join. In terms of the resources, we are going to announce them soon. Soon. All right. Okay. So again, thank you so much. Bye bye.